there's no question that something bigger is happening. I mean, there is no question about that, right? And um, a lot of it focuses on the LBMA. I'm going to try and make this part a little bit easier to understand. It's somewhat complicated for people who don't understand the lingo. I'll try to make it as easy as possible. First of all, when you look at gold, speculators are returning into the gold market. We can see that on COMEX with open interest rising again. That means open interest is the amount of interest, and people are interested in buying the metal.
Something historic is happening in real time, and almost no one is talking about it. Andy Schectman just sounded the alarm. The silver market has reached a singularity. Nearly 1.9 billion fake paper ounces are now collapsing into just 140 million real ones left in London's vaults. Lease rates are exploding, deliveries are breaking records, and the world's biggest bullion banks are cornered. This isn't a theory. It's the math that could break the global paper silver market. And if Andy is right, this is the moment that separates those holding paper promises from those holding real metal.
Open interest is rising and prices are breaking out of this consolidation range. We see it bust out again. That's the normal link between purchasing and higher prices, right? But in silver, what we're seeing is something different. The rally is being driven not by speculators, but what seems to me by some form of a short squeeze. Because you have record high lease rates in London to lease the gold. That would be the same thing if you wanted to short a stock. There's a cost to borrow the stock from an entity that then allows you to short it. A stock is something, if you short something or naked short something you don't have, you have to borrow the stock first and then short it. Same thing here. You have record high lease rates with silver in London, anywhere between 5 and 6.5%. Normally, those lease rates are somewhere around 1% or a fraction of a percent. Even in times of stress, they barely get above 1%. Right now, they're between 5.5% and 6%. I'll talk more about that in a minute. But you also have falling open interest, meaning the demand by the speculators is falling with heavy delivery demand. So far, 58 million ounces have been delivered since late August. Almost 11,000 tons have been delivered year to date. This points to shrinking physical liquidity and mounting pressure on the market. In other words, the short positions are struggling to get the metal to cover their positions. As the lease rates go higher, the people who own it are like, nah, we're not going to give it away 5 or 6%, which is way higher than it ever is. With everyone standing for delivery, this is a problem. And when we talk about what's happening on the LBMA, recent data shows about 600 million ounces of silver are traded every day in London. There's about between 1 and 2 billion ounces of paper claims on meaning they could stand for delivery, between 1 and 2 billion ounces, yet the official available free float is only 140 million ounces. So in other words, if there's 1 to 2 billion ounces of claims against 140 million ounces available to be delivered, and a lot of that is already locked up and not truly liquid, what could possibly go wrong? In other words, London has virtually no free silver to meet these rising investor demands or to back the billions of ounces in outstanding contracts. This is getting interesting. And at the same time, you see the COMEX flush with metal. All of that metal, I remember I screaming, this is not about tariffs. And all of that metal that's come back to the United States has put I believe, the U.S. banks on solid footing. Normally, when the U.S. bank shorts COMEX, they go long delivery contract in London to offset. Well, they've brought all that metal back, and you could argue to put their book in order. These European banks are facing an existential threat. With lease rates and prices spiking, the risk of a delivery default in London is rising. And, this is the chain reaction that you would talk about. Silver, its status as a Giffin good. I don't know if you know what a Giffin good is. Then again, a Giffin good is something that as prices rise, demand increases. Most assets or investables are the opposite of that. As the price spikes, demand falls. With this, as price rises, demand increases, making shortages even worse. As the industrials will say, man, the price is rising, we got to buy more, we got to get it, we got to secure it. The hedge funds and the traders say the price is rising, let's jump on, let's get them on board on this. And its status as a Giffin good makes the potential shortfall even worse. Now, when we talk about silver, as far as I'm concerned, it's up 43% this year. And when you have a Fed that is going to come in and lower rates into an environment where asset prices are at or near all-time highs in the stock market, in gold, when silver's on this run, I would expect to see this rocket fuel charged. When the market was from 2007 to 2011, when they cut rates, gold went up 118%. From 2020 to 21, when they cut rates, gold went up 35%. So I think not only will you see that in silver, you will see it certainly in gold. But going back to silver for a moment, 52 million ounces of silver were already delivered on COMEX this month, with 3 weeks left to go to push it even higher, just over 2 weeks. And as I mentioned, those lease rates at as high as 6.4%, they never get above 1 to 2%. And if only briefly when they do in times of stress. This is signaling that the bullion banks are trapped by their own over-leveraged promissory notes, the European bullion banks in particular. I think that's something that needs to be focused on. At the same time, you have silver added to the strategic minerals list by the U.S. government. This means that big buyers are entering the market, including the U.S. government. Companies like Tesla and others will stockpile silver at the same time. And so London's deliverable silver supply is vanishing. Its industrial needs and its investor demands are colliding between the industrials like Tesla and the investors. This is Giffin's good at work.
Schectman explains that what we're seeing right now isn't a normal market rally. It's a liquidity crisis disguised as a price surge. On COMEX, open interest in gold is climbing again as speculators return, but in silver, something very different is unfolding. Silver's rise isn't driven by investor enthusiasm. It's driven by panic. London's silver lease rates have exploded to 6.4%, up from a normal 1%, as bullion banks scramble to find physical ounces to back their shorts. Since late August, over 58 million ounces have been delivered, and year-to-date deliveries have crossed 11,000 tons. That's not speculation, that's stress. Schectman points out that the LBMA trades about 600 million ounces of silver every day, yet the deliverable supply is only around 140 million ounces, much of it already spoken for. Against 1 to 2 billion ounces of paper contracts, that's a ticking time bomb. And while European banks face this existential pressure, U.S. banks quietly brought silver back home, shielding themselves from London's growing delivery risk. Meanwhile, the U.S. government just added silver to its strategic minerals list, putting it in the same class as lithium and rare earths. That means government and industrial giants like Tesla are now competing directly with investors for physical supply. Add in record central bank gold buying, India's ongoing silver import surge, and BRICS countries shifting to real assets, and the cracks in the Western paper system are widening fast. Schectman calls silver a Giffin good, an asset where demand actually rises as the price rises. Industrial users rush to lock in supply, while investors panic buy to avoid being left behind. This feedback loop makes shortages even more severe. Technically, silver has been coiling in a 45-year cup and handle formation, one of the strongest continuation patterns in all of finance. A breakout above $50 would project prices toward $90 to $100 per ounce, according to traditional charting rules. Combine that with collapsing supply, industrial hoarding, and BRICS' ongoing de-dollarization, and triple-digit silver stops being fantasy. As Andy says, this is 45 years of suppressed energy waiting to explode.
I don't know. I'm looking for a severe shortage. Not to mention, you have a 45-year cup and handle pattern on silver, which is one of the most powerful technical setups you can find in markets, period. And on such a long time frame, it carries huge implications. It portrays 45 years of suppressed energy ready to be released. kind of like a coiled spring. And I think that the structural and monetary pressure, once unleashed, the move is violent. The way that it typically works is that a cup and handle is a continuation pattern. The cup is the long base. In silver's case, from the early 1980s through the decades of the consolidation. The handle is the pullback, the tightening range, like 2011. So once prices break above the rim, that $50 price that we saw in 1980 and 2011, the price can go parabolic. The classic charting rules, the upside target, you take the depth of the cup added to the breakout point. So the depth of the cup, the rim is at 50, the bottom is just below $4 in the 1990s. That's about a $46 or $47 spread between the top and the bottom. So in theory, the breakout above 50 with no resistance above it, add $46, $47, the difference from the top to the bottom of the cup, you're at a $100 initial target, between $90 and $100. And when you throw in the shortage, when you throw in the demand by the big money, when you throw in the demand by the BRICS countries, et cetera, I don't know, triple-digit silver isn't really so out of control. It's not out of line as far as I'm concerned. One last point I'd like to make about gold and silver. You know, it's interesting to me that, and in particular gold, because silver has yet to catch the same fire that silver has, that gold has caught. And, you know, we look back over the last half a year or so, and the S&P 500 in the last 5 months or so is up almost 1,700 points. That's one of the strongest rallies in history, right? Gold is up about almost 40%, about 39%. When compared to the S&P's return over the last 5 months, which is one of the strongest returns ever. Gold is up since 2023. Gold's up 100%. The S&P is 67%. That's great. But just over the last 6 months, where everyone's focusing on NVIDIA and stuff, where it's up as big as it is, 1,650 points, gold's run is up 4 times the S&P's return just in the last 6 months. It's up 37% versus 9%. And so even amongst this AI boom, the biggest tech story since the internet, equities are still trailing gold, and yet nobody talks about it. So I remember when gold finally broke through $400. I couldn't believe it. It finally broke through $400 all those years ago. And if you would have told me that we are sitting at futures almost at $3,700 right now, and the media and no one understands it, to me, it's absolutely insanity. The big money understands it. And this is what I was talking about recently, where you have the largest exposure to stocks in the history of the stock market by mom-pa investor. You have the largest ever margin exposure, which is $1 trillion, and you have the largest exposure to options. So you have the public all in on stocks, all in on margin, and all in on speculation with options. At the same time, the investor, the big money, the insiders are leaving at a 7-to-1 clip, leaving the equity market and going where? I don't know. Maybe they're going to gold, as the biggest money in the United States is standing for billions and billions and billions and billions and billions, and I can keep on going every single month. Every single month we are seeing huge deliveries into COMEX. And why does nobody talk about it? So let's just paint the backdrop for a minute and talk about our wonderful mainstream media that lacks all journalistic integrity, period. The greatest boom ever in the S&P because of the AI revolution is trailing the price of gold and silver. The insiders are dumping equities and running to, we don't know, as the public is all in the stock market, not just all in, greater than at any time in history. In fact, not only are they in greater than any time in history, the valuation is at the highest point in history, greater than the 1929 crash, greater than the '08 crash, greater than the dot-com crash. And they're not just all in, they're all in on leverage and margin. And so with all of this metal coming into COMEX, both gold and silver, record amounts, net importers, record amounts, and the public not owning any, and it outperforming the S&P, where the hell is Fox News? Where the hell is this idiot Jim Cramer? Where the hell are all the people that are supposedly looking out for you and I?
Andy's direct message to investors is clear. The window to prepare is closing. While the mainstream media chases the AI bubble and the S&P's record highs, gold has quietly outperformed stocks, rising 37% in the last 6 months, while insiders are dumping equities at a 7-to-1 ratio. The smart money is leaving paper and moving into real assets, gold, silver, and tangible wealth. So ask yourself, if 1.9 billion paper ounces are chasing 140 million real ones, what happens when everyone demands delivery at once? Does silver explode past $100, or does the paper market finally collapse? This is the moment Andy Schectman has been warning about for years, the moment when confidence in paper silver dies and physical ownership becomes everything. If you believe in sound money, if you want to stay informed when the reset hits, subscribe to Metal Watch, hit that like button, and drop your thoughts below. Are we witnessing the beginning of the Silver Singularity? Because once the vaults run dry, there's no going back.